December 12th, 2012. Goulburn, Australia. Armed tactical units surround a modest suburban house. Inside, an unemployed man on $400 a week in government assistance is fast asleep, next to the keys of an Aston Martin, a Maserati, and a bank account sitting $2.1 million below zero. To the police, this was an open and shut case of wire fraud. He was sentenced to years in maximum security. Case closed. Except for one extraordinary detail. Throughout 29 months of continuous spending, he never used a fake name, never altered a line of software, and never told his bank a single lie. Every single dollar he withdrew had been formally requested, processed by the bank's central mainframe, and billed to his address with a monthly invoice. And when 3 Supreme Court judges finally sat down with the fine print of the contract, the entire prosecution detonated in reverse. How does someone extract millions from one of the largest banking institutions on earth without breaking a single law? And what was written in the terms of service that forced the state to release him and pay him hundreds of thousands in damages? Before the story ends, you'll see the exact overdraft receipt that should have triggered an automatic account freeze and didn't. You'll see the internal audit memo, drafted 11 months into the scheme, that a mid-level compliance officer buried in a routine filing cabinet instead of escalating it. You'll see the moment a defense attorney realized the bank's own printed contract had a clause nobody at the institution had read in over a decade. And you'll see why, of everything the prosecution presented at trial, the single most damaging piece of evidence against the state turned out to be the bank's own monthly statements. This is the file that forced one of Australia's largest financial institutions to quietly rewrite its account terms nationwide. This is Blackfile Investigations. And this is the case the courts eventually filed as a matter of consent, not fraud. The case of a 24-year-old former warehouse worker named Nathan Cole. Cole's story begins in the least remarkable way possible. In early 2010, laid off from a logistics warehouse outside Canberra and living on a modest government job seeker allowance, he opened a standard transaction account with Southern Federated Bank to receive his fortnightly payments. The account came with a small, pre-approved overdraft facility of $900, a routine courtesy extended to thousands of similar accounts across the bank's retail network, designed to cover the occasional insufficient funds transaction without triggering a declined card at the checkout. Cole used the account exactly as intended for the better part of a year, occasionally dipping a few $100s into the overdraft and repaying it within the agreed grace period, generating nothing that would distinguish his file from tens of thousands of others processed by the bank's retail systems every week. The routine broke on a Tuesday afternoon in March 2010 when Cole withdrew $40 from an ATM outside a suburban shopping center, expecting the transaction to be declined. His account balance, after the $900 overdraft limit, should have shown insufficient funds. Instead, the machine dispensed the cash, and the receipt, when he checked it later that evening on the bank's telephone banking line, showed a new balance of negative $940. $40 beyond his approved limit, processed without so much as a warning message. He assumed reasonably that it was a one-time system error, the kind of minor glitch every large institution occasionally produces and quietly corrects. He didn't report it. 2 days later, testing what he still believed was a fluke, he withdrew another $60. The transaction cleared exactly the same way. Cole would later describe in testimony given during his appeal the specific unease of that first week. The sense that he was waiting for a phone call that never came, checking his mailbox each afternoon for a letter from the bank flagging the discrepancy, half convinced that admitting what he'd found to a friend or family member would somehow make the error more real, more likely to be noticed and reversed before he'd had a chance to understand it. He kept a small paper notebook, purchased specifically for the purpose, where he logged each withdrawal alongside the balance shown on his next telephone banking call. Not out of any criminal intent, he would later insist, but out of the same instinct that makes a person double-check a vending machine that's dispensed 2 items for the price of 1. He wanted to understand whether the pattern was real before he decided what, if anything, to do about it. What Cole had stumbled into, though he wouldn't understand the full mechanism for several more weeks, was a genuine architectural flaw in how Southern Federated Bank's retail banking platform handled overdraft enforcement across 2 separate, poorly synchronized systems. The bank's core ledger, which recorded account balances in real time, was supposed to communicate directly with a separate authorization engine responsible for approving or declining point-of-sale and ATM transactions against a customer's available limit. For accounts opened after a 2009 platform migration, Kohl's among them, a configuration error meant the authorization engine was checking transactions against the account's original $900 limit as recorded at account opening, while the core ledger continued accumulating actual withdrawals without ever updating the figure the authorization engine referenced. In practice, the authorization system believed Kohl's available balance reset to a fixed ceiling every billing cycle, regardless of what he had already withdrawn. For the first several months after the discovery, Kohl's use of the flaw stayed genuinely modest. A few $100s here and there, always eventually offset by his regular government payments, never approaching anything that would look, from the bank's side, like deliberate exploitation rather than an unusually forgetful customer occasionally dipping into overdraft. That changed gradually over the second half of 2010, as Kohl began testing the actual boundaries of what the system would allow. He withdrew $1,000 in a single day. Nothing happened. He withdrew $3,000 the following week, split across 2 ATMs in different suburbs, partly out of genuine curiosity about whether the system tracked location, partly because a $3,000 single withdrawal felt, even to him, like something that should have triggered a phone call from the bank's fraud department. No call came. By the end of 2010, Kohl had stopped thinking of the flaw as something to occasionally exploit and started treating it as, in his own later court testimony, the only steady income I had. He withdrew funds methodically in amounts calibrated to avoid the specific transaction thresholds he'd learned, through trial rather than any technical knowledge, tended to attract additional scrutiny at other institutions. He used the money first for practical purposes: a mortgage payment on a modest property he'd bought before the layoff, insurance premiums, groceries. Every transaction, without exception, was processed under his real name, his real account number, and his real residential address, generating a monthly statement mailed directly to his front door that itemized every withdrawal in complete, unambiguous detail. The notebook Kohl had started as a private curiosity in March grew, by the end of that year, into something closer to an operating manual. He recorded not just balances, but timing, noting, for instance, that withdrawals made in the final 10 minutes before the bank's nightly batch reconciliation process appeared to clear slightly faster than those made earlier in the day, a pattern he never fully understood but learned to exploit anyway. He began splitting larger purchases across multiple smaller ATM withdrawals over consecutive days rather than a single large transaction, not because he believed it would evade detection from a determined investigator, but because it matched the rhythm of a normal customer managing tight finances, and normal customers, he correctly gambled, drew far less institutional attention than dramatic single transactions did. Every choice he made was less the work of a criminal mastermind and more the accumulated, unglamorous caution of someone gradually testing how far an obviously broken system could bend before someone finally noticed. The scale of what Kohl was doing might have gone entirely undetected for years if he had continued treating the flaw with the same restraint he'd shown in 2010. He didn't. Over the following 18 months, the withdrawals accelerated sharply. Sports memorabilia, a Maserati purchased outright through a private dealer who ran no more than a routine credit check. An Aston Martin acquired the same way months later. A 7-meter fishing boat, luxury travel, and a growing collection of high-end collectibles. By late 2011, Kohl's account balance, according to the bank's own internal records later entered into evidence, had fallen to nearly $1.4 million in the negative, and the monthly statements documenting every dollar of it continued arriving at his address without interruption. The Aston Martin purchase in particular became a focal point of the district court's original trial, largely because of how mundane the transaction itself had been. Kohl drove to a licensed dealership outside Sydney, inquired about the vehicle exactly as any legitimate buyer would, and arranged payment through a standard bank transfer initiated from his own account using his own online banking credentials. The dealership's finance manager, interviewed as a matter of routine during the investigation, testified that nothing about the transaction had struck him as unusual. The transfer cleared within the bank's normal processing window, the funds settled, and the paperwork was completed the same afternoon. It was procedurally indistinguishable from thousands of legitimate luxury vehicle purchases the same dealership processed every year. And that ordinariness was precisely the detail prosecutors would later struggle to explain to a jury as anything other than what it technically was. A compliance analyst at Southern Federated Bank's Fraud Monitoring Division A woman named Priya Anand, who had joined the fraud team 8 months earlier after transferring from the bank's mortgage underwriting unit, was the first person inside the institution to flag Cole's account as a genuine anomaly rather than a rounding artifact in a batch report. Reviewing a routine list of accounts with overdraft balances exceeding $50,000, a report her team ran quarterly more out of regulatory obligation than any expectation of finding something significant, Anand noticed Cole's account sitting not at $50,000, but at nearly $900,000 negative, a figure so far outside the normal distribution that she initially assumed it was a data entry error in the report itself. She spent the better part of a week manually reconciling Cole's transaction history against the account's original terms before concluding, in a memo dated November 2011, that the account reflected a systemic authorization failure requiring immediate escalation to platform engineering and account freeze. That memo never reached platform engineering. Anand's direct supervisor, reviewing the flagged account as part of a routine sign-off process, downgraded the escalation from urgent to standard priority, reasoning, according to his own later testimony, that a customer spending money the bank's own systems continue to authorize represented at worst a civil recovery matter rather than an active security incident requiring emergency intervention. The memo was filed, not escalated, and sat unread in a compliance archive for another 13 months, while Cole's balance continued falling. Anand raised the account a second time in February 2012, this time verbally, during a routine team meeting where quarterly high-risk accounts were briefly reviewed. According to two colleagues who were later interviewed as part of the civil litigation, she specifically asked whether Cole's file had been escalated to engineering and was told the matter had been handled at the appropriate level, a phrase that appears nowhere in the bank's own written escalation procedures, and that neither her supervisor nor his own manager could later explain when asked directly under oath. Anand did not raise the account a third time. She left Southern Federated Bank for a position at a different institution 8 months before the case became public. And in a brief statement provided to a journalist covering the eventual court ruling, she said only that she had done what the job asked of me and the job didn't ask enough. What finally triggered action wasn't Anand's original memo. It was a routine external audit, conducted by an outside firm as part of Southern Federated Bank's standard annual compliance review, that flagged Cole's account during a random sample of high-risk overdraft positions in late 2012. The auditor, working entirely from spreadsheet data with no knowledge of Anand's earlier internal warning, escalated the finding directly to the bank's chief risk officer within 48 hours, a route around the exact internal bottleneck that had buried the original memo a year earlier. Within a week, Southern Federated Bank froze Cole's account, referred the case to New South Wales Police, and began preparing a civil claim to recover the nearly $2.1 million Cole had withdrawn by that point. Deep dive investigations into cases like this one, reconstructing internal bank memos, tracing authorization system architecture, and cross-referencing years of court filings and take hundreds of hours of independent research to piece together accurately. If you value documentation this detailed, on cases the mainstream financial press only ever covers in a single sensational headline, consider supporting our work directly via the Buy Me a Coffee link in the pinned comment below. Your support is what keeps investigations like this one funded independently, without cutting corners on the research that actually explains how it happened. The December 2012 raid on Cole's Goulburn house produced almost none of the resistance investigators had prepared for. Cole was arrested without incident, and the bulk of the investigation that followed focused not on establishing whether he had taken the money, a fact never seriously disputed at any stage, but on characterizing the legal nature of what he had done. Prosecutors charged Cole with obtaining financial advantage by deception, a charge requiring proof that he had actively misled the bank about his intentions or entitlement to the funds, and with dealing in the proceeds of crime. At his initial trial in a district court, prosecutors leaned heavily on the sheer scale of the withdrawals and the luxury purchases as evidence of clear criminal intent, securing a conviction and a sentence of 4.5 years. The prosecution's central exhibit at that first trial was a single spreadsheet, compiled by a forensic accountant, plotting every withdrawal against the account's growing negative balance in a steep, almost theatrical upward curve. Presented to a jury without the surrounding technical context of how the authorization system actually functioned, the chart did exactly what prosecutors intended. It made $2.1 million in accumulated overdraft look indistinguishable from a calculated theft, rather than what the appellate court would later determine it technically was. A customer repeatedly asking a question, a broken system kept answering yes to. Cole's original trial counsel, a junior barrister handling his first case of this scale, called no expert witness to explain the authorization engine's architecture to the jury, a decision his appellate team would later describe, diplomatically, as a significant strategic gap in the original defense. Cole's defense, largely overlooked by the district court, hinged entirely on a detail his trial counsel had raised but failed to fully develop. Every transaction he made had been affirmatively authorized by the bank's own automated systems using his verified identity without a single instance of impersonation, hacking, or system manipulation on his part. On appeal, a new defense team built the entire case around this single fact, arguing that deception under the relevant statute required an active misrepresentation and that a customer requesting a withdrawal the bank's own systems approved using entirely truthful account information had deceived no one. The bank, the appeal argued, had not been tricked. It had consented, repeatedly, automatically, and in writing, via the very monthly statements it had mailed to Cole's real address, documenting every dollar as it left the account. Cole's new counsel, a barrister named Damien Okafor, who had built his practice largely on financial regulatory disputes rather than criminal defense, later described the moment he first requested the bank's standard account terms from Southern Federated Bank's own legal department as almost anticlimactic. The document arrived within days, unredacted, exactly as any customer could have requested it themselves. Okafor read the overdraft clause on a train home from a client meeting and, by his own account, read it 3 more times that same evening, checking and rechecking the specific wording against the district court's original reasoning, before concluding that the entire criminal conviction rested on a legal theory the bank's own paperwork appeared to directly contradict. He filed the appeal application 2 weeks later. The appellate hearing turned on a single piece of paper neither the original prosecution nor the district court had examined closely. The standard account terms and conditions every Southern Federated Bank customer, including Cole, had agreed to upon opening a transaction account. Buried in a clause governing overdraft facilities, the contract stated that any transaction processed and authorized by the bank's systems shall be deemed a valid extension of credit under these terms, regardless of whether such transaction exceeds a customer's nominated limit, unless and until the bank formally notifies the customer of a limit variation. No lawyer at the bank, in the decade since that boilerplate clause had been drafted, appeared to have considered what it would mean if the bank's own systems simply failed to enforce the limit at all. 3 appellate judges spent the better part of a single hearing walking both counsel through the precise wording, and by the end of it, the panel's questions had shifted almost entirely away from Cole's conduct and toward the bank's own contractual language. Senior counsel for Southern Federated Bank, appearing as an interested party given the civil implications of the criminal ruling, argued that the clause had clearly been intended to cover minor, incidental overages, a customer's card being approved for $11 over their limit at a checkout, not a systemic failure spanning 29 months and nearly $2.1 million. The presiding judge's response, later quoted in the published judgment, became the single most cited line from the entire case. Intention is not written into a contract. Wording is, and this bank wrote very broad wording indeed. It was according to 2 barristers who observed the hearing and were later interviewed for a law journal retrospective on the case, the moment everyone in the courtroom understood which way the ruling would go. The ruling that followed overturned Cole's conviction on the deception charge entirely, finding that a defendant cannot be said to have deceived an institution into authorizing transactions the institution's own systems approved under the plain terms of its own contract. The court was careful to note that this was not an endorsement of what Cole had done, and left open the civil liability Southern Federated Bank could still pursue to recover the funds. But on the criminal charge that had put him in a maximum security facility, the panel's finding was unambiguous. Without deception, there was no crime under the statute as written. Cole was released after serving roughly 5 months of his original sentence, and in a subsequent civil settlement, Southern Federated Bank was ordered to pay him a portion of his legal costs and a further sum in damages tied to what the court described as the bank's own documented and prolonged failure to enforce terms it drafted and controlled entirely. The ruling's consequences extended well beyond Cole's own case. Within 18 months, Southern Federated Bank had rewritten the overdraft clause in every standard account contract it issued nationwide, closing the exact loophole the appellate panel had identified and adding an explicit provision allowing the bank to reverse transactions processed in error regardless of how much time had passed since authorization. Regulators, reviewing the ruling as part of a broader industry consultation, later cited the case in guidance issued to every major retail bank in the country, recommending mandatory quarterly audits of authorization engine synchronization. The exact category of technical failure that had gone unaddressed in Cole's file for over a year after Priya Anand first flagged it. Cole himself, by his own account in a handful of interviews given after his release, used part of his settlement to complete a paralegal certificate, and has said publicly that he has no interest in ever holding a bank account with an overdraft facility again. So who really came out ahead in the case of Nathan Cole? A man with no technical skill, no fake identity, and no intention beyond noticing that a machine kept giving him money, walked away from a maximum security sentence because the institution that built the system refused, for over a year, to read its own contract carefully enough to stop him. Both things are true here at once. Cole spent nearly $2.1 million that was never legitimately his, and a panel of appellate judges concluded, based entirely on the bank's own paperwork, that not one of those transactions met the legal definition of a crime. This case made it to the channel. Not everyone does. So, who really deserves the blame here? The man who kept asking a question the bank's own systems kept answering yes to, or the institution that spent 13 months sitting on an internal warning while nearly $1 million in additional losses accumulated? Leave your answer below. Half of you are about to disagree with the other half.